What do you build? Do you enjoy
Welcome to the Lapp podcast.
Do not try this at home. Brian Adams, welcome to the podcast.
Thank you for having me.
Yeah.
This is quite the treat. In
Pleasure.
person,
I know, right?
coffee, cigars. This is
Exactly.
like-
Friday afternoon,
man, absolutely.
3 o'clock on a Friday afternoon, and you
Beautiful
just
way to end the week.
absolutely it is. And you said that you closed a big deal. Was that today or was that this week?
Yeah, we formally, we formally acquired a property today as of noon, maybe local.
Okay.
So suburban Detroit. It's kind of in the Birmingham area, if you know where that is at all. But good affluent area, 100% occupied, smaller deal, so probably $10, $11 million acquisition.
Okay.
But it's 12% cash on cash yield, which is just really hard to find these days.
Yeah.
And so I don't want to use a bunch of jargon off the bat, but
It's okay. You can get technical.
6.8.
People can Google it.
So it's over 6 years, the weighted average lease term, which basically means a ton of stability. It's going to be really steady Eddie. Year one is 14% cash on cash, and then it kind of dials back a little bit because of some lease turnover. And this is crazy. I've been doing this 11 years, raising capital, doing commercial real estate. We launched this one at 11 o'clock on President's Day, so federal holiday. And in Nashville, it was a snow day. It was kind of bad weather.
I remember. Can you confirm what you mean by launch?
We sent it out to our investor network to solicit investment. And so we sent it out to 400 people probably initially. And it was, in retrospect, a holiday and bad weather, kind of suboptimal. And we've been working on our marketing, our content creation, and really trying to go deeper with our current investors. So we didn't know what was going to happen. It had been a while since we had raised on a deal. We raised $3.5 million in under 12 hours.
Wow.
2x oversubscribed.
Oh, wow.
Unbelievable.
Yeah.
And in commercial real estate's relative. Some people that's not a big number. Other people it's a huge number. For us, that's significant.
Okay.
But just the appetite level for yield, unlike anything I've ever experienced. So
On this particular deal.
just in general, people are looking
okay.
for cash flow. They want passive income. I think they're worried about where the market is right now. Mm-hmm. They're afraid about inflation. They don't really know what's going to be happening with this new stimulus bill. And so you've seen just this huge appetite for real assets coupled with some kind of income orientation with it. And obviously the tax advantages that come with direct real estate ownership, but just the appetite level is through the roof. There's just not enough product. Everything's been bought up. So
Can you just pull that mic a little bit closer to you?
Sorry.
And by the way, just
Better?
pull the mic towards you. You can stay comfortable. That thing just moves around. Yeah, there you go.
There you
Perfect.
go. Good.
All right. So your 300 or 400, are you doing syndication? Is that basically what it is?
That's exactly what we're doing.
Okay. So you're going to
Purely deal by deal.
Okay.
So we create an LLC. The only thing in that LLC is that one particular property. No cross-collateralization on debt or equity with anything else. Everyone's common equity, so everyone is treated the same.
Okay.
And there's probably 25 to 50 people or entities per investment is probably average for us. And the 80-20 rule definitely applies. So usually, 80% of the equity is from 20% of the number of investors.
Sure.
And vice versa.
Yep.
But we only work with taxable investors. So what I mean by that is individuals, families, or private wealth management firms that work with those type of folks. We don't have any institutional investors in our deals.
Okay. Because you don't want them, or because you haven't gone after them yet, or
Because I don't want them.
okay.
Because I have the privilege of not needing them.
Okay.
And I've done that before, and it's not a very fun way to do business. And I'm at a place where I need investors, but I don't need to work with jerks.
Yes. And you find more jerks per capita in the institutional world than you do in Common American streets.
It's just hard, and I have this conversation with emerging managers or people that want to get into this business, this sponsor business. And a lot of them think, if I could just get that one investor to unlock all these doors, the golden chalice, if I could just get this insurance company, this pension plan, this endowment, this big family office. And, the reality is it never works that way. And if somebody's going to be 95% of your equity, rightfully so, they're going to want huge amount of control, huge amount of oversight, huge amount of economics. And, that might work for some groups, but it's just a hard way to do business, in my opinion. And these people, because I know them, they're all really smart. They're well capitalized, and they have really good third-party vendors they work with. So it's just going to be a slog.
Yeah.
And my speed and the way that I've built the company is to cater towards individuals and families. And that's who I like to work with. So that's what I mean by,
Makes total sense. So is this office space? What is this in Detroit? And by the way, I'm a little bit surprised about the Detroit thing. I don't know a lot about, and you can use this little guy here to keep that lit, but you just press right here. My assumption is that Detroit is maybe not the most up-and-coming city in America anymore. So I'm kind of surprised you're investing there.
Yeah. So to give context, we probably have 2.5 million square feet under management. Call it 400 million of gross asset value of properties. And they're all, for the most part, secondary markets. So think of places like Nashville, although we can't afford to buy anything here anymore. Richmond, Virginia, Kansas City, Kansas, Cincinnati, those type of markets. And a place like Detroit is exactly where we'd like to be, because the thought process from a lot of investors based on the coast is it's the Rust Belt. There's nothing there. It's a flyover state, which is great for us, right? We like not sexy. And Detroit, the population is actually, the loss is plateaued and is starting to gain again.
Oh, it is?
And part of our investment thesis is that this maturing millennial generation, I don't know how old you are, I'm 38.
36.
So this maturing millennial generation, you don't qualify, I barely do. Or you qualify, and I'm barely on the edge of it. The narrative on a lot of Wall Street kind of investment folks is you and I are going to live in Brooklyn, wear skinny jeans, eat avocado toast, never have a family, never have kids.
Yep.
And that's going to be our life. We're going to rent forever. And the reality is, because of the Great Recession, that family formation phase got pushed back 3 to 5 years for a lot of people for economic reasons. But they are starting to get married, have children, and make decisions about where they want to live, work, and play based on quality of life, cost of living, access to single-family homes, and access to education for their children. And so they're boomeranging back to what I call Big 10, Big 12, SEC country. And so places like Detroit, really affordable, really high quality of life, because they have the infrastructure of a population that's 2 or 3x what it is today.
Was it really 2 or 3x at one point?
At one point,
or it was just built for that and it never got there?
No, I mean, at one point, I think it was the 7th largest city in America.
Man, I can't imagine that.
Same with Pittsburgh.
Wow.
Those places just used to have incredible volume of people. Good lesson for Nashville and a lot of cities that are experiencing growth right now. That it's kind of like the S&P. I think the S&P has like an average turnover of 20% a year. So you think, oh, these cities or these names are stalwarts, but it's always changing. So, yeah, Detroit is coming back, and it still has really good. I mean, the downtown is still working to come back, but there's still these pockets of affluence in these suburban neighborhoods that never really went away. So that's one of the reasons that we like it. That's the investment thesis in terms of the millennial migration from a city level, but then we kind of break it down into these submarkets, these pocket neighborhoods. And the Southfield, Michigan, which is where Birmingham, Detroit is really strong from a metric standpoint. And one of the reasons I love being a fundless sponsor, I'm not beholden to a fund document or a PPM that says I can only go to these certain geographic areas. I like to go where there's opportunity, right? And I found something like this. The numbers are great. We like the area. Smaller deal, which we've had to kind of push towards smaller deals because there's been so much competition. It just checked all the boxes, and we're pretty excited about it.
Yeah. So, and by fundless sponsor, you just mean that you don't have an institutional investor, correct? Is that what that means?
It means I don't have an institutional investor. It means I don't have discretionary capital. So it means that I don't have a pool of capital that I can call on that's legally obligated to fund when I find a deal.
Okay. Got it.
So I raise deal by deal, which means I'm going at risk. I'm putting my own money in, obviously, the management team is, but people haven't legally signed saying, hey, I'm going to commit $1 million to you. You can call it whenever you want. I don't have that optionality.
Got it. Yep. But then on the flip side of that, you have all of the control about which deal you want to go after. And then it's just a matter of, can you find the investors or not?
Correct.
And didn't have a hard time finding those investors.
Yeah. And I think there's a misconception that you'll raise on a good deal. And I have a whole presentation about that misconception, but this one just checked all the boxes. And it's, the way that I pitch and the way that I market and the way that I present to my investors is from an empathetic standpoint. So instead of me finding a really good deal and saying, you need to do this because I'm smart and this is a good deal, I listen to what my LPs, my limited partners, my investors, what they want, and I just try to give it to them.
Oh, okay.
So it's a little bit of a different approach than you see in our industry in a lot of times. But I knew going in, anything north of a 10% yield, anything that had a weighted average lease term of over 5 years, anything that was in a good submarket, so the vacancy rate was below 10% for the product type, and had non-traditional office use. So this is mostly medical. It has some kind of experiential retail, like a garage and that kind of thing. I knew it just checked all the boxes. And yeah, I mean, the appetite was strong.
So it's office space, but it's non-traditional office space.
It's what it's called flex, which is like the mullet of commercial real estate. It's kind of business in the front and then party in the back. So it's retail facing or maybe office facing, single story, the kind of product type that you see around an airport oftentimes.
Sure. Yeah.
Like here in Nashville.
Yep.
You've got kind of dock bays or distribution industrial usage in the back with the ability to load if you need to. And it's a great product type right now because there's no common areas. There's no hallways. There's no shared bathrooms. All ingress egress is through the one specific tenant space. So there's no worries about kind of COVID issues there.
I see.
People can control the access that they want to control.
Yeah.
And the really beautiful thing is most of this product type is triple net, which means that all of the expenses are borne by the tenants.
Yep.
So from an asset management perspective, it's just much easier there, which allows us to have more flexibility with distributions.
Yep. I don't have a ton of experience with triple net. I have more experience with residential, and then a few years ago bought a property that had commercial up front and residential in the back, and that was my kind of segue into a little bit more of the triple net stuff. But the residential in the back, with my experience there, it gave me some confidence level to buy the property, and it was my best property that I've ever had. But the triple net is actually pretty sweet when the tenants are paying insurance, taxes, and maintenance.
Yes, it makes
if you can find a good deal.
It makes your underwriting a lot easier. It's kind of a fire. This is multi-tenant, so it's not a fire and forget. I mean, we have some asset management to do, but if you can find it, it's great.
So then your Excelsior Capital, right? Excelsior Capital handles all the tenant relations. Investors don't have to touch it. They're just getting their disbursements from you whenever that is.
Yeah. So the pitch is no pass-through liability to the investors. We take care of all the brain damage and the heartburn of the day-to-day. Now, we do third-party property management lease. So we will have a group in Detroit who handles changing the light bulbs, the the roof leaks, the snow removal. They'll do all that, and then we'll third party with like a JLL or a CBRE or a Cushman to do the leasing work.
I see.
So we pay them market, and but on the asset level. So in terms of strategically positioning the building to perform the way we want it to perform, capital expenditures, deferred maintenance, leasing decisions, refinancing, all that kind of stuff, we handle ourselves. So theoretically, when an investor were to give us $100, the only liability they have is to fund that initial $100, and then ideally the investor experiences, they get their monthly distributions, they get their quarterly reports, they get their annual K1s, and they're happy. So that's kind of the goal.
Is the exit plan for the investors on a property like this to sell the property or to refinance at some point? What's the play here, the longer term play?
Most of our investors, they don't want the capital back unless it's going to be a big multiple on their investment.
Okay.
IRR is not a meaningful metric for them for the most part, because they're looking for that kind of passive income, that coupon, that distribution dividend. They don't necessarily have a great place to put the money back to work to get a commensurate return. So unless it's going to be a really big hit, they would prefer to just keep it moving, keep those monthly distribution checks coming.
Okay.
So these are long-term holds. And that is definitely something that we try to be very transparent about. Is this is illiquid. You should assume a 10-year hold. If you can't stomach that, this is probably not for you. This is not a buy it and then flip it type of deal. So we put long-term debt on. We assume that we're going to hold it for a long time, and that cash on cash is representative of an average of that 10-year hold. So every month is going to be a little bit different depending on how that property is performing and what's happening on the asset level.
Does it ever turn out where you're looking at a 12% cash on cash return and it winds up just averaging out to 8% and investors get unhappy and then you just sell the deal and move on?
Yeah, I mean,
does that happen, or is that very uncommon?
Not every deal works the way that we underwrite. And we've certainly exited deals early, but unless if the property is actually performing within a range of, call it 8 to 12%, so 200 to 400 basis points off of what you had modeled originally, you don't want to sell from a position of weakness, and we haven't had to do that to date. So luckily we haven't had any issues along those lines, but we've had some wins where we sold earlier than we would have anticipated.
Okay.
And I've, had some deals that have not gone as per pro forma for sure. I've not batted 1,000. I don't think anybody has. But we've carved out this nice little niche where these $10 million acquisitions that are well occupied, stabilized, cash flowing, we've done a nice job there. So I think the biggest thing that we need to guard against is style drift as a manager, going after bigger deals, going after different type of deals.
Okay.
That's where I've told my investors, that's when you should really make sure that I'm sticking to my knitting, including my management team, right? Because I think if you raise like you raised on that deal, right, your initial response as a manager is, well, go find me more product.
Yeah.
And you want to be guarded against that, because that's when you can really get out over your skis and get into trouble.
Yep.
And there's an adage in real estate that it's the same amount of brand damage to do a $10 million deal as it is a $100 million deal, which is true. But the economics are probably a lot better at that $10 million deal because it's a more inefficient space. But that's why you see managers go out and raise bigger funds, do bigger deals. They have initial success, and then that's where their returns revert to the mean.
Okay, so the returns come down, but obviously the dollar amount goes up, and you're putting in the same amount of work anyway. Okay, interesting. And so that property is, you put out the request for funds on President's Day. We got all that snow in Nashville, and today at noon, you bought it. It's yours.
Correct.
Yeah, congratulations.
Thanks.
Cheers to that, my man.
Appreciate it.
That's worthwhile.
I always hate closing a deal on a Friday or penciling it in because it's just hardly ever works. But this one went smooth.
I think you already answered or spoke to one of my questions I was going to ask you is if you get into other types of real estate then as well, or do you really try to stick into commercial in that, 10 to 20, $30 million mark and secondary market? Is that sort of the niche that Excelsior is in?
That's the pitch. So we do commercial. For us, commercial means anything from office to industrial to that flex product that I talked about to not straight medical office building. So don't think of it as an on-campus or on-medical center property, but more of a medical arts. So a LASIK eye center, a dialysis clinic, typically doesn't have an OR in it. That's a product type that we would do for sure. But we don't do any single family. We don't do any multifamily.
Okay.
We just don't have that expertise.
Okay. So. Yeah. So you're going to stay in your wheelhouse and just stick with that.
Yes.
If you find deals that are worthwhile doing, great. And if not, you just keep looking and waiting. But you're not going to be looking outside that asset class.
No.
Okay.
And we found that price point, 10 to 15 million, is inefficient. There aren't a lot of good buyers in that space. So, there's typically a syndication of high net worth individuals or a broker that would try to put together those deals, but they don't have our track record. They're probably tough to work with. They'll probably retrade you, maybe cut you back on your fees. And so for us, we always act as a gentleman. We always transact as gentlemen. And that's what's allowed us to get some off-market looks. Still broker-driven, but maybe limited distribution, or we get a first look at it before it goes out live kind of thing.
And you're only working with accredited investors.
Correct.
And if someone's listening that isn't an accredited investor and by the end of this conversation, it sounds interesting, where could they, is there like an email thing they could sign up and become one of those 300 or 400 people that gets emailed next time? Or
yeah, I appreciate that question. You can go to the website, excelsiorgp.com, and you can enter into the process there. Or I'm really active on LinkedIn. That's how we connected.
Okay.
You can just reach out to me and we'll do a phone call and go from there.
Okay. Yeah. Okay, let's go back around. First of all, you mentioned Pittsburgh and Detroit, two pretty major hockey cities back in the day. I have seen somewhere that you are a little bit into hockey. Are you still, or have you followed this more in the past? Or?
Yeah, I have a unhealthy emotional relationship with the Predators, I would say.
Oh, really?
Yeah, it's probably a little bit too much. I grew up in upstate New York, so I played upstate New York.
Where in upstate?
Northeast of Albany on the Vermont border.
Oh, okay. Yeah, that's true upstate. We were Finger Lakes.
Oh, nice.
Yeah.
Where?
Watkins Glen.
Yeah, where they have the race.
You ever come down for a NASCAR race?
No, but I played hockey and lacrosse growing up, and so I spent a lot of time in what I would call Western New York.
Yeah, it is.
Yeah. Only if you're from upstate would you call that Western New York. If you're from like White Plains, everything's upstate New York. Yeah. But people don't realize that to go from like where I live to Buffalo it's like an 8-hour drive.
That's super far. Yeah, I mean, for sure.
It's just a different world. So yeah. But I grew up a Cuse fan, so we'd go to Cuse lacrosse games.
Okay.
And then I played in high school. You play like Empires for lacrosse, and we would play against like all those powerhouse Western New York teams.
Okay.
Out in that part of the world. So yeah,
okay.
My folks are still up there. But I with the pandemic, I haven't been in over a year.
Yeah.
So.
Yeah. I mean, it's Western New York, as you say, or Central New York. It's a great place. The Finger Lakes, gorgeous, beautiful.
Geneva and the vineyards up there are really pretty.
The vineyards are great. The wineries are great. Thousand Islands, beautiful, man.
Yeah.
But it's cold a lot of part of the year. You know what I mean? It's like, this is what I like about Nashville is, we had that week of snow and literally we just stayed home all week pretty much. I barely worked that week. It was kind of embarrassing. Only a couple of days I worked but it was great. I mean, we were playing in the snow, watching movies at night with the kids and everything. And then guess what? A week later, 60 degrees and gone.
I know.
And if this was upstate New York, a week later, it'd still be there. And a week later, it'd still be there. And a month later, it'd still be there.
Yeah. I mean, that's, I try to tell people it's a beautiful place, great place to grow up. Wouldn't trade it for the world, but March and April are the cruelest months in that part of the world because it's tantalizingly close.
Yes.
But I remember playing lacrosse games in like deep into April, snow on the ground, freezing, brutal. And I mean, I remember snow in May a couple times for sure.
I do too.
And it's just, hard when you're in your 20s or your 30s. There's just not a lot going on up there, right?
Yeah.
I mean, Albany, it was about 45 minutes from my house. And that's where I went to high school, went to a private school there. And it's a great place to grow up, but if it wasn't the capital of New York, ain't a whole... And my family's been up there since the 17th century. It's like a long time.
No kidding.
In the Hudson Valley area.
Oh, wow.
And it's just not... There's just nothing going on there.
Yeah.
It's quiet.
Yep.
So
what are your thoughts on the Preds? You've been following them closely. I was for a good while, and then something about COVID and sports, man, I don't know. I just kind of lost touch with. I'd watched 1 or 2 football games this year, one of which was a Super Bowl. Just haven't been following sports with
you
COVID
a Bills
and everything.
fan?
No, I was when I was a kid.
Okay.
I remember having Bills socks, and I had Bills onesie PJs, man. They were awesome. And those socks had... Yeah. Do you remember the little kid socks back in the day? They'd have that little bit of rubber on the bottom.
Yeah.
I don't see that anymore. But I had socks like that, and they had Bills on them. So I was a super hardcore Bills fan. But my dad was into the 49ers, so then I kind of shifted over to the 49ers, and I like their colors better anyway.
Well, your dad's a smart guy. So yeah, grew up in upstate New York. I played, competitive hockey in high school, and then I played lacrosse in college.
Why not hockey?
I was better at lacrosse.
Oh, really?
I wasn't a great
Okay.
hockey player. I was a bad skater. In that part of the world, we had a pretty competitive program in high school, and early on, you realize there are guys that you play with that are going to play like Ivy League or maybe AHL, and you realize when you're a sophomore or junior, like, wow, I'm not anywhere near that good.
Yeah.
So I'm going to put that away and focus on something else.
Yep.
But I still am a huge fan, and I love the NHL. And when I moved here, my father-in-law, who we were talking about before we went live, is from Manhattan. So he grew up playing and was a big Rangers fan. So he's a day one season ticket holder for the Preds.
Oh, yeah? Okay.
So when I first moved here...
99, right?
98, 99.
Yeah, right
It was
around
right
there,
around
yeah.
when the Titans... It was before the Titans... It was when the Titans moved here, but they had already left Houston. So they had those weird years where they played in Memphis for a year, and then they played at Vanderbilt for a year.
Oh, I didn't know that.
And I think it was like the same year that they started playing at... They called it Adelphia, or whatever the old stadium was.
Okay.
But yeah, 98-ish was...
Okay.
Because when they went on that run, it was like their 20-year anniversary. In 2017.
Yes, that's right. Yes.
So it's just about 20 years. So yeah, their 25 is coming up. But anyways, I was in heaven when I moved here. We didn't have kids, obviously. And, those like Tuesday night in October games that nobody goes to, I was drinking beer, having like a ball. And my father-in-law has 3 daughters. And I was the first one to get married.
Oh, okay.
So he was just so happy to like have a guy to go to the
Oh,
games with.
sure. Yeah.
And
So he doesn't have any sons.
No.
Okay.
And he's an interesting guy. He's a trauma surgeon by trade, but he took a company public in the 90s. So, and he's a huge sports fan, so he does not mess around with his seats. He's got, offense twice, blue line, 35 seats up above the glass, just like killer, unbelievable seats.
Nice.
So yeah, I just became a huge Preds fan when I moved here, and they had pretty good success. And then 2017, when they made that run, I think I went to all the playoff games.
Dude, we went to so many games that year. I happened to have half-season tickets that year and the year after, and they don't extend into the playoffs. I went to a couple playoff games, but they were getting expensive.
Yeah, it was
so
wild.
I checked out pretty quick, but just watched every single game on TV. Man, me and my boys, they were a little younger at the time, but they were super into it, man.
So yeah,
that was so fun.
It was so
I will
much
say
fun.
this for the sports fans out there. Those years when the Preds was going for it, if you were in that stadium or if you were there live in those games, it was like an experience. I'd say second to none. I mean, I've never been to a Super Bowl, but that was pretty epic.
I mean, I remember it was the Western Conference Finals, and it was the same weekend as CMA Fest.
Yes.
And why am I blanking on this? The big music fest that's down in Bonnaroo.
Yes.
And it was wild.
It was crazy.
Like, I went downtown early, which is unimaginable with COVID. But like, I went downtown early, and I mean, there were probably 100,000 people downtown, easy. And it was insane. And it was so much. It was the most fun I've had with my clothes on. Like, that playoff run was incredible.
It really was. Oh my goodness. It really was. But I haven't been following them so much this year. I've heard they're not doing so good.
They're bad this year.
Okay.
And I love Poyle. I love him. But it might just be time to... I'm a New York fan, so like the minute things go bad, I just want to fire everybody.
Yeah.
Because that's how I grew up with, like, in the city, or my dad being a Rangers and a Mets fan. But they're bad. I mean, we don't have any character. If you were to ask like a pretty big hockey fan, you know, what style do we play, or how would you describe our play? We're nondescript.
Okay.
We're mediocre.
Yeah.
Our goaltending is poor. We don't have great leadership. I'm not, and this is not going to come across well, but I'm not a huge fan of a European captain. I just think you need some.
Knock on Yossi, huh?
I love Yossi. He's a beautiful man.
He's talented.
And he's like, somebody who loved him very much taught him to skate early. He's a beautiful skater.
Yeah.
But I feel like you need a guy that played in the Western Hockey League to get in that room and scream at people.
Okay.
And so
I don't disagree with that.
You know, they just don't. I don't know. They just don't look like they're having fun playing. I'm not a big fan of the coach.
You're not.
So
It's still Laviolette.
no, it's the guy that got fired by the Devils last year, Hines.
Oh, okay.
Yeah.
Okay.
He was a USA Hockey guy, so he knew Poyle from when Poyle was running
I see.
USA Hockey at the Olympics. And again, they just, and it's part of it is this new realignment with COVID. Their division is brutal. We have to play the Lightning 8 times. That sucks. You know, it's very competitive, but I think they should throw in the towel, dumpster dive, and get some new talent, frankly. But
all right, enough of the small talk, my man. Here we go. On January the 20th of this year, you tweeted, this is a quote from Charlie Bilello, U.S. SPAC, so Special Purpose Acquisition Companies, U.S. SPAC IPO capital raise, 2013, $1 billion, 2014, $2 billion, 2015, $4 billion, 2016, $3 billion. By the way, in SPAC. So this is a group that gets money together and goes public without actually having a business that later buys a business, right? So is that fair for an SPAC, or do you want to add something to that just so people have context?
no, I'd say that's fair. I mean, it's basically an alternative way to go public. That's not a traditional IPO. So the investment banks are not involved in the sale and the fundraising process. And you're raising a blind pool of capital with the intention of within 2 years buying a company, and they automatically become publicly traded via that.
Yes. This is not something I was familiar with. All right. So these SPACs raising the amount of money is what we're talking about here. In 2016, they raised $3 billion. 2017, they raised $11 billion. 2018, raised $9 billion. 2019, they raised $13 billion. 2020, $83 billion.
And that's an outdated number. Yeah. 20.
And 2021, here 2 weeks in, they'd raised $15 billion in 2 weeks. What the heck? What is going on?
So, I mean, I'm not going to pretend I'm not a Wall Street guy, but I think what you're seeing play out is kind of a New York versus San Francisco turf war, where the tech bros are pissed off that the investment banks get to make all these money on fees to take their companies public via the traditional route.
Okay.
And oftentimes what you see happen is the bulge bracket, think Goldman Sachs, JP Morgan, et cetera. What they do is they convince management team to come in at a lower valuation when they're doing an IPO, and then they hook up their ultra high net worth clients and their buddies with the stock pre-sale, right, the IPO, And then there's a pop. You hear about that pop, right? Like, oh, XYZ company went IPO and it popped 10%, 20% day one. Well, those guys get the benefit of that pop.
The investment banks do?
The investment banks and the buddies that they hook up to get in early on those deals.
Okay.
And it pisses off the tech bros because the tech bros say, you should have just valued the company fairly and given me 20% more of my interest. So I think that's part of it. And then also, there's just so much damn liquidity in the system because the Fed has been running the printing press for the last 12 months that these companies allow for like super speed transactions without having a bunch of really smart research analysts have to dig in.
Right.
Because what you saw play out with WeWork, for instance, WeWork just kept raising more and more rounds of venture funding at bigger and bigger valuations until they got to SoftBank, which is the biggest gorilla on the block. And SoftBank was like, well, we don't have anywhere else to go with this. We have to take you public because we have to get liquidity. Well, research analysts in Wall Street, you can poo-poo them, but they're really smart people. And so once they open up the books, they realize like this company is dog shit. Doesn't make any money. It's got way too much debt. They do all these things that don't have anything to do with their core business. And that's when the IPO died. So I think some of these, SPACs, these special purpose acquisition companies, I think they don't want to necessarily go through that rigor of having these guys look at everything. So it's de rigueur right now. I mean, it is like the sexiest thing on the market, and there's been a ton of activity there.
SPAC is.
Yeah. But I don't think it's going to end terribly well. And like most things, I've got a real close friend who's a former hedge fund guy out of New York that lives here now. And he always says, if Wall Street has a product that is an abbreviation and uses a bunch of jargon terms that you and I don't know, and we're smart. Like if you and I don't know what it is, it means that retail investors are getting ripped off. And I think that's pretty accurate for the most part, right? I mean, this is a complex, and I've done webinars, I've done interviews with people that like really know what they're doing, and they've explained it to me, and it's complex. There's a lot going on there. So I think this is a case of the Wall Street guys and the people sponsoring the deals are going to make a lot of money, and some retail guys are going to get hurt. Retail investors, if I had to guess.
I mean, it's just so much. I mean,
It's a lot.
2019, 13 billion, and then 2020, 83 billion in the middle of a global pandemic. So do you think that's more money shifting from other places in the market into the SPAC, or is it just additional liquidity raising it, or a combination?
I think it's all the above.
Okay.
I mean, if you look at, and I posted this on LinkedIn yesterday, at some point this week, we're at an all-time high of zero revenue, billion plus market cap companies today. So
yeah, I think
so
I saw
these
it on
are
Twitter.
These are billion plus market cap, these are large companies. Amazon's one of them. That they're not profitable.
But Amazon isn't, aren't they?
They don't make a profit. They make a lot of
I
revenue.
didn't know that about Amazon.
Yeah,
So I thought they were profitable.
it's all revenue growth.
yeah.
And they make a shitload of revenue growth.
Yeah.
I mean, they're smart. They know what they're doing. But Bezos has said from day one, do not value this company based on profitability. We're going to grow. And that's been the venture model for the last 10 plus years is we'll worry about how to make money later. Let's just keep top line revenue growing.
Yeah. How long do you think that's going to last?
Until the music stops.
Okay. I mean, because as a founder, if you have a good idea and you have capital being thrown at you, that to me seems like a dream scenario, because as the founder, you can just focus on revenue and customers and the business. I mean, that's fantastic, and not have to worry, if you need more money, just go get it, But for most of the businesses out there, they don't get to do that. They have to make money or they go out of business.
Correct.
So do you think that with this focus on growth, is this sort of a specific thing that we've been seeing since, I don't know, when you would say 2000, 2010 until now, that's sort of this anomaly, that it's not going to be like this forever, that in the coming 10, 20 years, that sort of being able to get by with just growth is going to go away?
I have no idea.
Okay.
I mean, that, and if you look at a company like Berkshire Hathaway, they're sitting on a record amount of cash. So is Apple. And the problem is their investment thesis is such that they want to invest in profitable companies. And there's just not a lot of great places to allocate capital right now. And I think that's part of the issue is it's called the Tina effect. There is no alternative. So if you have cash, right, and if the Fed has been running the printing presses, people have been getting stimulus checks, if we're basically on universal basic income, and if you're an investor and you look around, you think, okay, well, bonds, 10 years returning me 1.5%. That sucks. Junk bonds are returning under 4%. That's not great. Real estate's expensive. If you want to participate in a REIT or a big fund, you're looking at a 5% return maybe. Mm-hmm. And then you look at stocks and you're like, damn, they're returning compounded 10 to 20% annually. Mm-hmm. Throw it in there. There's no other place to put that amount of liquidity to work.
Yeah. Yeah. That makes sense. But I also want to ask you about stocks. So this is from your Twitter's a gold mine, by the way. Yeah, a lot of good stuff on there. What is your Twitter handle? I think it's Brian C. Adams, right?
Yeah. I basically take my LinkedIn postings.
Oh, do you really?
Twitter,
okay.
Yeah.
Okay. I didn't actually look through your LinkedIn postings, but I was just looking through your Twitter. So you're a lot more active on LinkedIn than Twitter.
Yeah.
But it looked like you had some great stuff in by the way, I have to ask this. How many people try to make like a clever comment or question about the Brian Adams thing, like with the singer?
Not a ton.
Oh, really?
It does happen from time to time. Yeah.
Do you ever listen to Brian Adams?
Yeah.
Favorite
Got some
song?
good stuff. Probably All for One, One for All.
That's
the Robin
good.
Hood soundtrack.
Yeah, I like that one. I like
Cuts Like a Knife.
Cuts Like a Knife. Everything I Do It For You. I like. Honestly, like Summer of '69 is probably one of my least favorite songs. Still, he's got great stuff. Anyhow, so you had on your Twitter, this is a guy, Jim Chanos, I guess, founder of Kinekos Associates. We're seeing a level of misunderstanding about how markets work that is being brought on by a whole new generation of investors who have never seen a bear market. It's a pretty bold statement. What's he saying, and what are your thoughts on that?
Yeah, so I mean, if you think you're in your mid to late 30s like me, I was in law school during '08, so I was not a market participant, and I didn't really understand what was going on at the time. You can watch The Big Short, but unless you're in the market, it's hard to know. And it's and I'm actually listening to Obama's autobiography right now, where he goes through TARP and the bailout. And
cool.
So it's super interesting.
What are you listening? What's it called?
His autobiography is called Promised Land. Mm-hmm. It's 2 parts. So this is part 1.
Oh, okay.
And this is not you can have whatever politics you have, but his retelling of that period of time is fascinating considering what's happening today.
Yeah, I'd love to hear that.
It's long. I mean, he's not short. He's long-winded. I mean, the whole thing, I think part 1 is 20 hours.
Whoa.
But it's
unabridged, obviously.
Yeah, and he reads it. So,
Obama does?
Yeah.
Oh, no kidding.
He's got a great reading voice.
Well, that's kind of cool. He does have a good voice.
And he's still not going to beat his wife's number on book sales. But yeah, so you've got this generation of people that, after '08, I think what presidents have started to realize is recessions are a bad business. Like the normal cycle of every 10 years, there's some type of recession. Presidents have realized that they can make the Fed and Treasury do stuff to avoid natural recessionary cycles. Mm-hmm. So if you look at what happened in '08, you look at what happened with COVID. I'm not saying it's the wrong decision, but it is what it is. They basically said, screw it, turn the printing presses on. Debt doesn't matter. Like the ratio of debt to our GDP, nobody cares. Don't worry about it. People still buy treasuries. Let's just pump liquidity in the market. We'll backstop these companies because that's what the Fed is doing, right? They're saying if you invest in the stock market, you're investing in the U.S. federal government because we're backing up these companies and we're backing up these bonds. Mm-hmm. They own a lot of the stock, right? So there's no downside. Like, why not? It's free money until it's not.
Right.
So we'll see how the carousel ends.
So you think we have been able to stay away from these bear markets so long because they're just printing money?
Presidents
primarily.
have the Fed and presidents have the Fed in their bully pulpit, and they know they can get fired if they don't do what they want. And it's easy money. And I go back to a family office perspective. There's a saying in the European family office world that they do art, gold, and real estate. That's how they've been able to maintain their assets over multi-generation. Now, I'm not saying that I'm not invested in the stock market. I'm actually not right now, but I certainly have in the past. But if you think about assets that have endured long term and avoided these, massive sell-offs or problems, you can probably have modern equivalents, but I like that asset allocation a lot. And I just have trouble with, I like to invest in things that are simple, that I understand. I'm not super smart. So if you were to tell me, okay, well, how does, XYZ tech company make money? I'd be hard pressed to understand exactly what they do.
Yeah.
But if you ask me how my deal in Detroit makes money, I'm like, well, yeah, I pay X, I put debt on it, and then I get the upside.
Yes.
It's pretty simple.
Yeah. I'm a lot less smart than you are, and I feel the same way, which kind of leads to another thing that I wanted to ask you about is it's just this idea of like how active should the average person be in the stock market? So let me get there, because right now I'm not either, for a few reasons. But this is another thing that I wanted to point out. You also had this on your Twitter, which is great. Jeremy Grantham, who is not a nobody. I mean, this guy has some assets. At least in 2015, he was managing over 118 billion, and who knows what it is now.
And the dude's a legend.
Yeah. But he also built a reputation on identifying, bubbles. And he said the long bull market has finally matured. And he's talking about now, he said the long bull market has finally matured into a fully fledged epic bubble featuring extreme overvaluation, explosive price increases, frenzied issuance, and speculative investor behavior. This will be recorded as one of the great bubbles of financial history. My question to you is, do you agree with him? And if so, how do you think that should translate into like the actions at an everyday level for our listeners? Like if we think we are really at this bubble, we're in a bubble and it's about to pop, which he's not saying it's about to pop, I guess. But if we're in a bubble, would the advice then be to sell off and go into cash or real estate, or to just be careful about what you're doing in the stock market? What would your advice be to kind of the everyday man based on that information?
Yeah, and I'm not in a position to give you financial advice. And I would say just this week we saw a correction in the NASDAQ, right? So tech stocks are down about 10% in the week. That's pretty dramatic. So I would say if you look at your asset allocation and your position in the market, if you are not going to be able to sleep with a 20% downside, then don't play the game. Because I think this is going to be a really volatile period of time where, these high flying tech stocks that have ripped since last April, it might be time for a bit of a reckoning. That being said, we're about to put another $2 trillion of money into the market. So it's weird. It's like, if you look at the Fed and what they said this week, it was like good news is bad news, because they were saying, yeah, we're turning the corner with COVID and things are opening back up and the economy's coming back, which meant treasury yields went up, which is a good thing. But the problem is when treasury yields go up, stocks in a relative basis look worse, right? Because if treasuries were pricing, if you could buy a 10-year at 5% or 8%, you do that all day. It's a risk-free investment. And if stocks are not going to give you something that's going to give you that pricing premium to the risk-free, then they don't look as attractive. So I think that's kind of what Grantham is talking about is, this isn't a game. it can be a game, but you need to be comfortable with it going to, 20, 40% down.
Yeah.
Which, I mean, I was in the market in Q1 last year, and some of my positions were down 35% in April. And I remember what that felt like. I wanted to throw up.
Yeah, I believe it.
And so now I've gone all cash, and obviously I'm participating in my real estate deals, but I'm scared to go back into the market. And I don't know when the right time is. That's the biggest problem. Is I've talked to my financial advisor, I've talked to really smart people. I'm like, what's an entry point here? Because we're at all-time highs. It's trading at 28%, I think 28 times book value, which is pretty steep. There doesn't seem to be a lot of deals out there. Mm-hmm. And I don't know how to entry this. Do I just put a percentage a month and then just kind of work my way in? Mm-hmm. Now I'm nervous.
So this is what I wanted to ask you about is I have a love-hate relationship with the stock market in that I have not been that interested in it over a long period of time, with some exceptions, because I felt like the amount of time that it takes to follow the market and try to be wise with it is more time than I care to give it. And if I would take that time and focus it on my own endeavors, that it would be better for me. And it's just, there's something about it that I think it's the thing of like having to follow the information closely. What I really love is looking at a deal like a property and running the numbers a bunch of different ways, being sure and leading up to one big decision. You make that decision and then you can just kind of move on, and some months it's more, some months it's less. Sometimes there's maintenance, whatever, but you made the decision, you buy and hold. I love the buy and hold thing. Stock market seems to be, and I know there's buy and hold in stock market too, but when it comes to things where you're having to follow it daily or weekly and keep after it, and there's people talking about it and it's new and sexy and you got to monitor all of that and make your decisions accordingly in kind of real time. Those are things I tend not to get that interested in. So what I would love to ask you about is has been some exceptions to that, by the way, which I remember in 2008 pacing outside I just remember where I was at. I was at my wife's family's house. We were visiting, and I was walking the road looking at stocks, and one stock was way, way low, and I did decide to buy some. It wasn't like hundreds of thousands of dollars that I was dealing with, but it was enough that if it went to zero, it was going to hurt, but also if it went back up to where it was, that was going to be really great. And so over that period of time, I was probably like the most interested. In a few years before that, taking some classes and kind of learning the market, But then in the last number of years, I've just not been that interested, but I have a lot of friends that are, and they're paying a lot of attention to it. I mean, shoot, they're making very good money, And so sometimes I wonder if I'm basically shorting myself and my family on an obligation. You know what I mean? Like to be kind of a wise, prudent steward of, your family's finances in today's day and age. Is part of that have to involve the stock market? Or is it okay if that's just not your thing and you don't want to pay that kind of attention to it and not deal with that volatility? If you have your own things that are more, buy and hold or more stable, and you can just kind of focus on that and kind of forget about all the noise over here. What are your thoughts on that?
Yeah, it's a great question. And the way I look at it, and again, I'm 38, right? So I'm a product of my experiences. And I know some of these folks, and it just seems like Wall Street and the machine and the products that they put out, they're the smartest guys on the street. Yet they seem to need a bailout every 10 years because they blow themselves up. So do I want to participate in that industry? And the second thing is, one of the reasons I love real estate is because it is illiquid. Because if in April and May, my investors had the opportunity, they probably would have cashed out at a 40% discount.
Yeah.
Because that's what the REIT market was, right? REITs are a synthetic representation of direct real estate investment. I think they're a poor synthetic, but they are. And if you look at the REIT market for office, it was down about 40%.
Was it really?
Yeah.
In April of last year?
Yeah. And these are
40%.
40%. And these are stocks that represent best in class properties in Midtown Manhattan, downtown San Francisco, Class A buildings, great credit tenancy, kicking off a 3 to 4% yield historically. So if my investors had their druthers and they could look at the scoreboard, they probably would have cashed out. That would have been the wrong call. And part of the reason I like my business is because there's no daily scoreboard. And I tell my folks, you can look at stuff monthly. You can look at the P&Ls. We'll provide them, obviously. We provide quarterly commentary. But for these things, you really shouldn't reassess where you are more than on an annual basis, in my opinion. And part of the beauty of it being illiquid is I can't sell when you want me to. Right?
That's right.
I've got a hold. Right. And you can talk about the future of office, and maybe we will, but I've been able to still send out my distributions, been able to still send out my dividends. I don't think it's accurate to say that my portfolio is trading at a 40% discount today. Mm-hmm. I like that part of it.
Mm-hmm. So you plan to get back in the stock market at some point, carefully?
I do. I'm sitting on a lot of cash right now. I don't have a lot of, we don't have a lot of real estate deals, right? I mean, there's just not a lot of product out there. And I've got a huge allocation of real estate, so I need to be careful there. Mm-hmm. I need to maintain some liquidity so I can participate in the deals. Mm-hmm. But I'm like everyone else. I'm looking for a risk-adjusted return, some kind of yield. You know, I think inflation is real, so I'm looking for income. I'd love to diversify outside of real estate. Oil and gas just has been crushed, so I'm not sure energy is where I want to be. I just don't know where to go. Mm-hmm. So I do think I'll probably go back. I kind of want to see what happens with the stimulus bill.
The $1.9 trillion?
$1.9 trillion.
Okay. Well, what do you mean see what happens with that? Because isn't that all locked down by now?
It's the Senate is reviewing it this weekend. They're going to make some changes to it. It's passed the House.
Oh, okay.
So I kind of want to see what the final version looks like.
Okay.
But yeah, I mean, I would think at some point this year I will.
Okay.
And I'll just let my money guy say. And what we'll probably do is, you know, we'll allocate X percent of my liquidity, and every month, no matter what the valuation is, we'll just put a certain amount in.
Yeah. Okay. Yeah. For those that haven't experienced being able to manage money at that level, myself included, what does that feel like?
For my financial advisor?
No, for you. You have all this money that's liquid and choosing whether you put it in stock market or not, or real estate or not. That sounds fun.
Yeah, I mean,
but not everyone gets to like make those decisions. You know what I mean?
Yeah.
Some people are just going to work and paying bills and
working hard,
hoping it all works out.
Yeah, I would say that it causes me immense stress.
The fear of loss, or the fear of missing out, or just wanting to maximize the assets at your disposal? What causes the stress?
When you have a peer group like I do, and you look across the hall and you see where they are in the ladder, and like this year, you know, I have a friend in the hedge fund business. They get paid out their bonuses, end of the year, right? So this dude brought home $6 million.
Yeah, that's not everybody.
And I know it comes across as obnoxious, and we're talking about like an infinitesimally small percentage of the world, but this is still somebody that, as a firstborn alpha male, I look to and I say, well, damn, what am I doing?
Yeah.
You know, he's able to do this. Mm-hmm. Now, he's getting crushed right now. But it's really hard not to compare and look at what the Joneses are doing.
Yeah, I'm sure. Are you a firstborn?
Yeah.
Okay. So is comparison something you deal with? Because I definitely deal with that.
All the time.
Oh, really?
All the time. It's hard not to.
Yeah. Are you able to manage it, or do you feel like it's driving you and eating you? And if you don't keep up, you know what I mean? Like there's probably a healthy aspect to that, and then there's also a very unhealthy aspect to that. How do you feel like you're handling that?
It's hard. I think millennial men were never given the vocabulary or the skill set to talk about their emotions.
Oh, that's interesting.
Period.
I wouldn't disagree with that.
So I think we had great, obviously everyone's different, but I had a great father figure. He's a wonderful guy. He's a worker. Dude's a grinder. He's a lawyer. And for him, value creation is based and directly correlated to the amount of time that he spends not with his family. Mm-hmm. That's how his professional services career works. Mm-hmm. It's like being a CPA and all these things, right?
Yeah.
So it's very hard for me to unplug without feeling guilty that I'm not being productive.
Okay.
Because I have seen, and I think it's wrong, but it's very hard to push back against this concept that you're correlating productivity with your self-worth. Mm-hmm. And that means that if you're not being productive, and we could talk about what that definition is, that means you are not living up to your abilities. And I think that leads to self-hatred.
Mm-hmm. Let's talk about the definition of productive there. What do you have in mind there?
The reason I got out of law and started what I did is I thought that I had the ability to use my intellect, creativity, and work ethic to create value for an enterprise independent of how much time I necessarily spent on something.
You thought you were able to do that as an attorney, or it struck you that you can't do that as an attorney, you need to get into another field?
Correct.
Aha, yeah.
Correct.
Yeah. And that, to me, totally stands to reason. Is it working out as you...
Sometimes.
In hindsight, can you see that if
Yeah.
you had stayed as an attorney, the answer to being productive is you just have to work your butt off, right?
Right. And that's kind of, the mentality in that sector is oftentimes, the beatings will continue until morale improves. Which is not how I wanted to run my company.
Yeah. Yeah.
And the solution is to just work harder.
Right.
And I think, if anything, being an entrepreneur for the last 11 years and seeing the power of how I've been able to leverage technology from a marketing, investor relations, reporting, everything, fundraising, sales, has taught me that you have to work hard, but there are a lot of opportunities to work smarter that are better for you and for your investors.
Yeah. You have kids or no?
I've got 2 boys, 8 and 5.
Oh, okay.
Yeah.
Okay. So even with the kids, have you seen moving out of the lawyer world into the entrepreneur world was good because you can add value and not just plug your time into that in such a direct way?
It's hard. I mean, pre-COVID, I was taking 150 flights a year.
Whoa.
So I was on the road, and a lot of those were 4-baggers. So, you go to Atlanta to get to Columbus, to whatever. And I would try to take as many day trips as I could. But, when you're getting on that, there's a 5:30 flight to Atlanta, and then you get back on the 11:10 or 11:30. You do the math on that from like when you're awake, it's pretty damn close to a 24-hour day.
That's so grueling. You seen investors, or what were you flying so much for?
Looking for deals, seeing investors, raising capital.
Okay.
And I think COVID has made me realize I don't need to do that to be effective. And I frankly don't think a lot of investors want to do the tortuous 3-hour steak dinner.
Okay.
And this is kind of part of the presentation I do as well, is I think a high value relationship should always be in person at some point.
Yeah.
But I don't think it should take every time.
Right.
And so what a lot of what I talk about with aspiring entrepreneurs is you should respect and empower your investors to make these decisions without forcing them to go to these painful lunches and dinners.
Yes. Yeah.
Because that was kind of the dance, right? It was like the email introduction, the phone call, the follow-up, and then a touch every month for 6 months. And then you figure out what you want to do.
Okay.
Now I think technology has allowed us to, LinkedIn, podcasts, webinars, blogs, like you can figure out what I do and who I am in an hour.
Yes.
On your own time.
Yep.
You could be on a plane. You could be at your desk pretending to work.
Yep.
You could be on the weekend with a beer, and you could figure it out. Mm-hmm. And if you're interested in what I do, you can reach out and we can talk.
Yeah.
And I'm happy to try to facilitate a in-person meeting in a post-COVID world. But it's really binary. It's like, listen, do you like the style of investing? Do you like the return profile? Do you like how I talk? Do you like how I think? Yes. Okay. Well, then it's a function of, do you like the specific deal or not?
Yep.
And then if you don't, that's cool. And it's really, I think that's what's allowed these like quicker raises and deeper relationships with the investors, is because I'm always around, but they can access me when they want to. Mm-hmm. It's not like, hey, Bob, I'm going to be in Kansas City Tuesday. We're going to have coffee.
Yes.
It's like, Bob may not want to do that on Tuesday, but he needs to find out what I'm all about.
Yeah.
But now he can do that on his own time.
Yes. Through these other ways of finding out who you are and how you think and all that, right? Because a lot of those torturous 3-hour steak dinners that no one really enjoys is just finding, it's just making sure you're a real person. Correct. And you're not out, screwing people, and you're doing it the right way. And there's a real person behind this, and everything is good, right? That's mostly what that's about, because they can see the numbers.
I think it's a reality check. And
okay.
And yeah, I think that's right. And I still think a big investment relationship is still going to at some point take place in person. I think part of what we've been able to do is I'm using some of that capital I built up over the last 10 years, right? I mean, all those flights, all those meetings, all those conferences, I'll be able to leverage it.
Yes.
To some extent. But moving forward, I'm just not sure that's how we're going to do this business. Mm-hmm. And that's where, to kind of tie back to real estate, I worry about some of these hotels. I worry about the airline industry. I just don't know if it's going to come. I don't think I'm ever going to take over 100 flights a year again.
In your lifetime or in your working career?
Period.
Both would be the. Really?
I don't think so.
At one point you were at 150. Now you don't think you're ever going to get back to even 100, because based on what you learned in the last year and a half.
I don't think so. Yeah. Because now when I pitch a deal, obviously with marketing and my story, I'm pre-selling, so people can really figure out what I'm all about. And then when I send them something, drone footage with a subtitled pitch, a recorded webinar with frequently asked questions, with pros and cons, with the full deck, with the full model. You can DocuSign if you want to just go ahead and do that. And then if you want to find time on my calendar for a call or a meeting, you can just click the calendar link. We don't have to go back and forth 20 times to figure out that 3:00 on Wednesday works for both of us.
Yeah.
It's just much more efficient.
Yeah.
And I think it's better for the investors and better for me.
Yeah. Yeah. I could see that. I mean, it seems like I guess what'll be interesting is the hotels, because the airlines, they tend to just get propped up pretty quick, right?
Yeah. They got bailed out by the feds again. So I assume they're going to be okay.
But the hotels, they're not going to get bailed out as quickly, correct?
Yeah. So I did a webinar with a hotelier. She was, her name's Millie Shaw, super smart. She actually went to UT Law. She said that over 95% of hoteliers, so people who own and operate hotels, access PPP funding. And it really saved their bacon. Mm-hmm. And it's coming back. But even she admitted that some of these big conference type setups, the hotels that rely on the sales conference coming in to San Diego once a year, probably the big ones are going to come back, but like the smaller get-togethers that you did quarterly, that might just be a Zoom now. Yeah.
I don't disagree with that. I also think Zoom is just not the same as being in person.
I agree.
Like there's some of these trade shows that we haven't launched this yet, but we're getting into the roofing industry in some capacity. And so, of course, I've not been in that before. And so I'm learning everything I can about it. And I want to go to these trade shows, of course. And, of course, they were all canceled last year for COVID. And one of them is going to be in April. And they're doing it virtually. I'm not attending it virtually. I'm just going to skip it,
Because a lot of the action at those conferences takes place between the meetings, right?
Yeah,
in the hallways,
exactly.
At the drinks, the dinners, and the breakfast before, and the spontaneous coffee meeting that you have with somebody.
Yep.
I don't disagree. But I'm just not sure, like, am I going to go have lunch with somebody in Richmond just because?
Yeah.
I don't think so.
Yeah. Yeah, it makes sense. You mentioned your peer network, and I have 2 questions on that. One, I think that maybe the people that have never experienced anything like that at that level may just assume, wealthy people kind of all like this is an over exaggeration, okay, but kind of assholes, and like you're in that peer group as long as you're doing well and productive and wealthy, I guess. And if that dips, they kick you to the curb. Do you sense that, or is there genuine relationships in that level of peer group? They just happen to be very wealthy.
Yeah, I think one of the misconceptions about family offices is that because they have X amount of dollars in the bank account, that they don't have problems. And it's just simply not true. And, it's one of those situations where there's a saying in that space, would you rather have the money and the problems or the problems and not the money? Because everybody has these problems.
Yeah.
And it's more about family by family and individual by individual, the culture that you build around that money. I am a firm believer that money has energy, and you can impart different energies to that money. And if you want to be a dick and you're rich, you're going to be a rich asshole.
Yeah.
But if you want to be thoughtful and empathetic and think about that money as stewardship and providing a quality of life to your lineage over multiple generations, and you do a good job of imparting that culture to your family, it's going to have a different energy around it. So are there certain groups that money is a way for them to keep score, but they're just on a treadmill to nowhere? Sure. I don't particularly associate with those folks. I mean, I think that's a tough way to live.
Yeah.
At the same time, there are certainly groups and people I know that have done very well. They've been very successful, and they have really positive energy around that money. Mm-hmm. And I love spending time with them because they have cool experiences. They're very thoughtful. They're trying to leverage that money to, improve the experiences and the quality of life for their family, which I think is admirable. And they're also doing other things with it to empower other people.
Mm-hmm. Yep. Yeah. Yeah. I'm not surprised to hear that at all. The second question to that was, I'm just curious, with kind of having a front row seat to these wealthy individuals and families, what are the common denominators that you're seeing among them that the, I guess, more average person who is not nearly as wealthy maybe is not espousing so much on kind of an everyday level, but the wealthy people, what are the common denominators you're seeing among these wealthy people that maybe less wealthy people could learn from?
Yeah, it's super interesting. This is a good question. When you look at somebody that's had a ton of success, and this is where it gets weird with Wall Street and financial services, and I see this with family offices all the time. They have a liquidity event, which means they sell their company goes IPO, they get a bucket of cash. And let's say they were in the timber industry, like multiple generations timber industry, right? When they have this liquidity, all of a sudden, all these people on Wall Street come out of the woodwork and they say, you need to diversify. And they try to become experts in hedge fund of funds or private equity or real estate. And my response is, you should just keep doing timber deals. You have expertise. Mm-hmm. And what you've seen with super successful people, like Tommy Friss is a great example. He is, and has been, and still is today, massively concentrated in HCA. And I don't think people appreciate the amount of risk that folks that have achieved that level of success took to arrive there. And what you see from a common fact pattern is massive amounts of concentration into one industry or one product with leverage and the ability to do it long term. And you kind of hear these stories, and the problem is, in America, we've got these origination fables where it's rags to riches. And we hear a lot about the rags and we hear a lot about the riches, but never the messy middle. Mm-hmm. And oftentimes the messy middle, they almost went bankrupt, or things got really scary, or they had a really tough patch and they like doubled down or tripled down on the business. And that's what allowed them to arrive at where they are. Mm-hmm. And it's very hard for people on the outside to just say, well, yeah, but look at him. He's now got this. Mm-hmm. It came with concentrated risk. Mm-hmm. And that's not for everybody.
Yeah.
And I think you have to be really serious about whether or not you want to participate in that game.
Yep.
Because it's hard.
Yep. So the willingness to take concentrated risk would be a common denominator among
With
these
leverage.
people with leverage. And you mentioned that twice. Is that because they just wouldn't have been able to do what they wound up doing if they weren't willing to leverage?
You juice your gains to such an outside level with that leverage. It can be prudent leverage. It could be non-recourse leverage, but it's there.
Yeah, I see. Okay. Any other common denominators you're seeing among these extra wealthy people?
They all invest with me for sure.
Well, that's one.
No. I mean, I would say concentrated leverage, risk taking, and just in a singular focus on whatever their widget is.
Also something that's overlooked or undervalued. But back to the example of the timber industry, they sell it, they're out. But how would they keep doing deals in the timber industry? Just for an example, like
Just wait till their earnout burns off and start another company.
oh, okay.
Or invest in young managers that they really like, do direct deals. I mean, they have this huge amount of expertise.
Okay.
Why do you want to get in the hedge fund business?
I see.
Right?
Sure.
That makes sense?
Yeah, it does make sense.
I just,
Yep.
oftentimes what I see, the fact pattern I see a lot is a family has a liquidity event. 10 years later, they say, man, okay, so think about it this way. We'll back up. Another misconception about family offices and why people really struggle pitching to them because they're not empathetic, because they approach them as like, hey, you're a capital allocator. You should allocate to me because I'm smart and I've got a good deal. But the reality is, if you think about it from their perspective, you've got a corpus of assets, like a bucket of capital, right? You need to maintain a quality of life across multiple generations. So that means you need to take into account inflation, so call it 2 or 3% annual. You need to count your spend rate, so whatever it costs to maintain that quality of life, let's put it at 4%, 5%. So you're at 8%. Now you've got an exponentially growing family because people have a tendency to have kids. So your 3 daughters have 3 daughters.
Yeah.
That gets out of hand quickly. You're dealing with 9 people, right?
Yep.
That's a lot of households. So in order to actually do it, you probably need to be doing 10 to 20% annual returns.
That's tough.
You can't do that in the market consistently.
Yeah.
So what you see is a family that had an operating company where they had the ability to create alpha for whatever reason. Like they had a moat, they had a better mousetrap, whatever. They sell to get liquidity. They've got this bucket of capital. And then 10 years later, they say, damn, like taking it into inflation and our spend rate and the exponential growth of my family and the taxes I had to pay on that money, I was better off just holding on to the deal. But the investment bankers did well on that deal, right?
Yeah.
They got 7%. And then they get to pitch you all these other products afterwards.
Okay. But also sometimes they're just looking for something different, right? They're looking to sort of get to relax a little bit, or like to not have to go to the office every day and run things quite so hands-on. Like, isn't that another reason that they would sell?
Maybe. I know very few first-generation wealth creators that can do that. Like truly dial it back.
Sure. Yeah.
My father-in-law is 74 and he still grinds. He's at the hospital right now.
Okay. Yeah.
I just like someone like my dad. He remarked to me 2 or 3 years ago, this is a cancer survivor, 60, he's 70.
Your dad?
Yeah. Lawyer. He said, Brian, great news. I'm like, oh, what's up, Pops? Like, what happened? I moved my offices from Albany to Troy. And I'm like, that's super exciting. Is that the news? And he's like, no, but you can't imagine it. I can get to my office in 12 minutes now. It used to take me 30.
Wow.
So now I can work more. Like, dude, you need a hobby, bro. Like,
Yeah.
but he's just not built that way.
But to your point, that's some pretty accurate insight into first generation wealth creators, right?
Because the issue becomes when you work that hard and you have that much success, I think the noise, everything else just gets turned down so low that the concept is called the hedonic treadmill. It's why once you build your dream house, after 3 to 5 years, you get bored with it. You want a beach house, and then you need a plane because like you just get normalized to it and socialized. And I think for some of these groups or these people, it's just really hard to get to move the needle anymore.
Yeah.
Unless they're in the game.
Yeah. Yeah, that makes sense. Do you want any bourbon to chase the rest of that cigar down with? Or you
No,
good?
I'm good.
Okay.
Thank you.
Inflation. What do you think? What's coming? And what I do remember is I remember being at some sort of a conference it had to be like 08 to 10, somewhere in that time frame, and just multiple speakers were like, inflation is coming in this country like you've never seen. And here we are, 2021, and it never happened. And so I sort of have a less frantic reaction to inflation now, but also understand that it could happen, right? And we're printing so much money. But now also because with just the way things are at now with all of this supply, our Fadi Busamra, who is the chief investment officer for Nashville's pension fund, was on here a couple of times. And
nice.
He was mentioning that, yeah, inflation could happen. He's not super concerned about it, at least in the near term, because what was he saying? Because supply is so great in this country. We have all these companies in manufacturing, and we have supply. Basically, we have supply that's greater than demand. Now, if supply and demand were a little more matched and we're printing all this money, that's going to create ridiculous inflation. Or certainly, if supply were to go under demand and we're printing all this money, that's just going to have rampant inflation. Okay, but inflation could still happen. I'm just curious, what do you think is going to happen in the next decade pertaining to inflation?
I'm the boy who cried wolf on this because I've been worried about inflation forever and it's never come. And the Fed is trying to get 2%. That's kind of the sweet spot. I personally think one of the big issues with the Fed is that they serve two masters. They're trying to get inflation right and employment right. And they have a dual mandate. And I think it's really hard for a federal government agency to have two mandates, I think is a challenge. They have enough trouble with one mandate.
Yep.
And if they're going to choose one, they're going to choose employment because that's what keeps them in power.
That's right.
People who are employed that have money in their pocket don't storm the Capitol.
Yep.
Like and we can get into that. But so to go back to inflation, I still think it's going to come. I'm concerned about it. I think you need to hedge against it. The issue is when. And, it's weird because when you look at the CPI numbers, they're pretty subdued. I don't think we're going to hit anything close to 2% this year, maybe not next year. But when you look at education and healthcare and housing, they're like 3 to 5x what the CPI inflation rate is. So it feels real to me as somebody that's paying for private tuition and paying for healthcare. It feels real. I mean, when I went to a private college, like a top 10, I was super fortunate. My parents paid. But I mean, when I was a freshman in 2000, and I went to Wesleyan, which is a liberal arts D3 school, my tuition was in the mid 30s, 30,000 plus a year, 35,000 plus a year. My brother, class of 09, when he went, it was in the 50s. And when he left, it was in the 60s.
Wow.
And when you look at private school, even in Nashville, it's going up, 3 to 5% annually. So there are pockets of the economy that make it feel real and that hurt. But then everyday consumer goods doesn't seem to. So it's confusing. I need an economist to help me out because it's a concept that I struggle with. And you would think at some point with so much liquidity in the system, it has to come. But guys like Foudy are much smarter than I am. I'm certainly not anything close to an economist, and it has not come to date.
Obviously, real estate would be a good way to hedge against inflation. Yeah, grab a water there, please. Real estate would be a good way to hedge inflation against inflation, right? What are some other ways? Is it just buying real assets, or
Yeah, classic inflation hedges would be commodities, which are been ripping lately. So you're talking like gold, copper, some of the rare earth metals that tech needs to use for their products. A lot of people think they're about to enter into a super cycle and really take off. So that's a nice inflation hedge.
What is that?
Just like a 10 or 20 year bull run
On
commodities.
Oh, I see. Okay.
So grain, pork bellies, those kind of stuff we consume. And then, obviously real assets. And to some extent, some of these digital currencies, if you believe in them.
Yeah, well, I wanted to ask you about that too. So, do you think that? Yeah, sure. I guess like cryptocurrency, Bitcoin being probably the most talked about one, or the one that has the most name recognition anyway. That would be a hedge against inflation. It would be, wouldn't it?
Yeah, I mean it's a synthetic, but it's a synthetic real asset. Art, wine, whiskey, classic cars. I mean, that's some pretty esoteric stuff, but
Well, and I think the art, wine, whiskey, and exotic cars, that probably works as an inflation hedge a little bit better when you're wealthy, right? I mean, for the average American, let's not go buy a bunch of wine, probably not, right?
yeah, but this democratization of access to alternatives is real. And not all of these crowdfunding sites are great in my opinion, but you can get fractional ownership of these things these days, which is really cool. And I think it's going to be something that we see, Robinhood was kind of a microcosm of it, but I think the empowerment of the retail investor in America is real, and Wall Street's losing its grip and its moat around some of these private equity alternative assets. And I think it's just going to explode. I think as a way to bridge this wealth gap, you're going to see, no matter who is in power in DC, you're going to see the dilution of the accredited investor status continue. You're going to see more and more people get access to these type of opportunities and deals. So it's not far-fetched. I mean, you can go on a thing like Yield Street and get access to, modern art, Renaissance art. I can't talk about the valuation. I have no idea, but it's coming. And I think you're just going to see more and more of it.
Oh, fascinating. I don't want to put you in a position where you can't talk about things for, if you have investors listening to this, or if you want to just totally stay away from politics, but do you care to comment on the Capitol riot? You mentioned that a second ago.
I don't do politics other than it's a political and business. Politics is a business reality, and it impacts my business. I try to not interplay with the two of them.
Okay.
Obviously, I don't like to see anybody get hurt.
Yep.
And it was sad to see. Looking back on it, it's unfortunate that so many people felt that much hatred and anger towards anybody. I would hate, I don't care what side of the political aisle you're on. It's frustrating because clearly these people don't think they're being heard. And the only way that they felt they could be heard was by acts of violence. So I'll probably leave my commentary there.
Yeah.
Because, I'm apolitical when it comes to my business.
Yeah.
But it certainly was a sad day, I think, for everybody.
Totally agree. Yeah, and I think you're being pretty generous. I think we don't need to get into it, but I think there's more involved there. I think these people had sort of this righteous cause they were fighting for, and they had their marching orders, wherever that was from, and they had these ideals and ideologies that they were chasing, and just got carried away, man.
And
it's crazy.
I'll go back. My undergraduate degree is in liberal arts, classic civilizations, that kind of thing. And I will say, I think a narrative that doesn't get talked much, and I'm not forgiving any actions, but something that we don't talk much about as a country any longer is the fact that, we've been at war for 20 years, and we have a segment of the population who, Now that it's a purely volunteer military, we have a large segment of the population that is one of the only options they have towards getting, a profession. And they've been on multiple combat tours that nobody really pays attention to any longer. Mm-hmm. We forget that we've been in Afghanistan since I was in college.
Yeah.
And that's a long time.
Yep.
You've got folks who have done 5+ tours of duty. And when they come back, they don't have employable skill sets. Mm-hmm. And they go back home to Idaho, where they don't have a lot to do and they have a lot of time on their hands. And we haven't done a good job of reorienting them towards being productive members of our society. Mm-hmm. And we, for the most part, have ostracized them. And there's a lot of anger and fear in those populations. Mm-hmm. And one of the things that you learn from history is when a ruling elite class uses a small minority of the population to do their dirty work, like when the Romans start outsourcing their military away from citizens towards some of these outer republics that they subsumed, it didn't end well. Mm. So I just wish that we would think through the blood and gold that we're spending on these campaigns and what the end game is, because there's a lot of people doing our dirty work for us.
Yeah.
It doesn't even make the front page anymore.
It's true. It's true.
Like, what is Biden's platform on this?
Yeah, I wouldn't be able to tell you.
Like, what are the 100,000 troops in Iraq doing right now? I don't know.
Yeah.
What is the end game in Afghanistan? Is it to create a democratic nation state that's going to be independent? Is it we're there to prevent them from collapsing? Mm-hmm. What does success look like? Mm-hmm. I have no idea.
Mm-hmm. Do you think that anyone has an idea?
No.
Or is it has to do with money and we're just going to follow that?
I think the scary thing is these are quagmires, that extraction means collapse, and nobody wants to have that on their hands. Mm-hmm.
Yeah, and it's also one of the things about, with the way we have leaders, at least the opportunity to cycle in and out every 4 years, is there's good and bad, and the bad is, well, let's just not have that on our hands, and let's just leave that for the next administration, right? I mean, there's a reality to that.
I mean, if you look at, and this is probably extreme, but if you look at what Charles Rangel, who is, a very liberal black Democrat from New York City, long-serving, his response was, I will vote for these campaigns if everybody in Congress has their children serve.
Yeah.
I think that changes the math.
Yeah, that changes the math for sure. That's a no-go at that point, right?
Yeah,
there's no way.
I can't imagine.
No way.
And I'm not saying that people don't serve, that there are families that are, representing us that have people that serve, but I mean, it's such a small percentage of the population now. Mm-hmm. But it's super concentrated within that small percentage of the population. If you go to a certain subset of the U.S. population, they all know people that served. Whereas in my network and social strata, I certainly know a few, and I respect the hell out of them. My brother-in-law is one. But I mean, I could probably put him on maybe one, maybe two hands tops.
Yeah. I'm in the same position, but for different reasons. I grew up Mennonite, and Mennonite people don't serve in the military. So I know very few people that have served. I know, a number, and respect them a ton. But I don't have a bunch of close family.
And again, I'm not forgiving all the action that took place by any means, but I just wish we would have a conversation about what we're doing here.
That is a fascinating angle, because that's not something that I was thinking in terms of a core group or a majority, or that these people that have served and are having a hard time fitting back into society, is sort of an at-risk demographic, if you will, for these types of things.
And
but I can see it.
And you've got
See it.
a country where we have more guns than people. So these are well-trained, angry, upset, militarized, weaponized people.
Yeah. Yeah.
And you know, I played lacrosse with a guy whose brother was the captain of the hockey team at West Point. He was a Ranger, and he was KIA in Afghanistan. They named a bridge after him in the North Shore of Massachusetts. Awesome family, terrific guy. Mm-hmm. And you kind of, I mean, like, what's the legacy?
Yeah.
Like, what does Biden tell his mom?
Yeah.
Like, what are we doing there?
Mm-hmm. Yeah. You're right.
What are the preconditions that would allow us to totally vacate that country?
Mm-hmm. Yeah, those are big questions. And also some of the motives going away, right? Because back in the day, we needed to go make sure we had this oil supply under our fist. But the need for that is going away.
Now we're a net exporter.
Yeah. Yeah. So hopefully some of that need, if you will, if it ever truly existed, I don't know. But hopefully some of that's going away to be fighting these wars. I think Bezos talking about Amazon. Bezos talking about going out and getting minerals from other comets.
Live on the moon.
And planets and bringing them back.
It's going to be great.
But, so that's one kind of angle where we go live on other planets like Mars. Obviously, you have Musk talking about that. But the Bezos thing is, I think, a more interesting and viable idea, which is, okay, so if we get into like these electric cars, a lot of people don't know, it actually takes a lot of mining to make these batteries. And so we need to make sure we can get that supply. And some of those countries aren't the most stable. But if we can get some of these minerals that we need for some of these things from other planets or comets, that's pretty interesting. Bring it back here. Let's stay living here, but bring what we need back here to Earth. I think that's a more viable option, at least in the near term, than going and living on other planets. But, we'll see.
Yeah, I'm not really sure. It's interesting. I can't remember his name, but I was listening to a podcast with this astrophysicist, and it was kind of like migrating to the moon or Mars is probably possible, but it doesn't solve the problem.
Yeah.
Like, we need to crack the code of go beyond the speed of light to find another viable place. Or we could just fix what we have here.
Yes.
But no one seems really, including me, I'd have this argument with my wife often, talking about these, climate change and the environment. And it's really hard because I don't want to give up my quality of life. Mm-hmm. I love my air conditioning. I love my cheap gas. I love to be able to fly to go have lunch with a guy and come back the same day.
Yep.
I don't want to give up any of that.
Yep.
And it's a hard decision to make, right?
Yeah. 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 I can see that. Let's touch on The Office. I don't want to keep you much longer. It's almost 5 o'clock, but future of office space. So last reading of one of your tweets, Andy Haldane, chief economist at the Bank of England, says exposure to new and different experiences, sounds, smells, environments, ideas, people is a key source of creative spark. Homeworking can starve us of many of these creative raw ingredients. From what I've gathered from looking you up a little bit is that you're a proponent of working in offices or having some amount of office work. Yeah, let's be upfront with the fact that you also buy office buildings and rent them out, right? So
I'm a landlord of 2 million square feet of office.
So you have that,
I'm
okay.
Terribly biased.
Sure. Okay, well, let's use your term and even say terribly biased, but also, you understand, you see why they're having these offices to begin with. So you have some level of understanding here that maybe the common person does not. I have some opinions on this front. I've been hearing for the last year about all this offices being vacated and staying vacated and everything. I'm not so sure because I'm a big environment guy. Like, I need to be in a certain place to do certain things, and I can't be at home and do certain things. It doesn't work. Now, I also have 5 kids, but even if half of them are out running around, it's just, in my opinion, you need certain environments to do certain things. So I've never really thought that office space is going away for good. And then Amazon, I think, is one of them too, that's saying, yeah, we're bringing people back sooner than later. We don't think the future of office work is totally virtual. What are your thoughts on this whole thing?
So pre-COVID, 4% of the workforce worked remotely. Different than work from home.
Mm-hmm.
Clearly in a post-COVID world, more of us are going to work remotely than 4%.
Mm-hmm.
That being said, I think what you saw in the last 12 months, because we're just about at a year now of this experiment, that initial spike in productivity that people experienced as employers, when you heard all the headlines of, this is great, we're never going to go back to the office, Twitter shutting down their offices, that novelty and the fear of getting fired increased a spike there. But then in the summer, and I have 15 employees, we experienced this starting around Memorial Day through the summer. People started feeling isolated, depressed, creativity was down, zero collaboration. Any new project launch or onboarding a new employee was just not possible. And what we realized is we will change the way we interact with office, but we are social animals. And there may be positions where if you're a coder, you can just chill in your closet and grind it,
Of course.
all day.
Yep.
I think those people should live in Boise.
Yep.
That's great. They're going to get paid less,
Yep.
which they don't realize. Bezos is not stupid. He's going to pay them less than when they live in San Francisco.
Yep.
But they can do it.
Yep.
But if you're in any kind of team, sales, marketing, biz dev, executive functionality where you need to make hard decisions, that spontaneity, it's just not possible over Zoom, in my opinion. I mean, look at the conversation we're having in person versus we were doing this on Zoom. It's not, the spark is not there, right?
It's totally not. I totally agree. That's
So-
why we only do this podcast in person.
I think what you'll see is, pre-COVID, there was this trend from the Great Recession up until last year where densification was the name of the game. WeWork and some of these other groups took space down to about 75 square feet per user. And so you had hot desking, hoteling, bullpens, cramming. Regardless of where we are with the vaccine, I think you'll see a return to more traditional office layouts, which is about 350 square feet per user. And you'll start to see offices be more kind of like this room, right? Bigger, open spaces where teams can meet, bounce ideas off each other, come up with ideas. Maybe you will work from home Monday and Friday, but Tuesday, Wednesday, Thursday, you're going to be in the office doing that type of work.
Yep.
And I don't really see that changing. And you've seen more and more. And if you look at the economy today, it's tech driven, right? And what Facebook and Amazon and Microsoft and Apple did during the downturn, they gobbled up as much cheap office space as they could. I mean, they're buying millions of square feet. New York, Austin, Dallas.
I didn't know that.
Yeah. Facebook took down 2 million square feet in New York of office. So they clearly think that that office is going to have a function in their world, right? And so I could see a hub and a spoke model where maybe everybody doesn't have to live in Silicon Valley. And maybe you have multiple teams distributed across various markets. But working from home 100% of the time, first off, for people like me, it's probably doable because I have my own office and I've got people that take care of my kids and I can do it. But for a lot of folks that have roommates, they live in a rental with their family, working at the kitchen desk is not feasible long term.
Yeah.
So I see I think people are going to really want, if you look at Nashville, in my office building in Belmead, it's 100% normal. Like it's back to normal.
Oh, is it? Okay.
Unless you work for a large publicly traded corporation, which has a COVID regulation in place that's saying, no, you can't do that. But if you're working for a smaller, medium-sized business, you're back in the office working.
Yeah.
Because you need to be. You can't be productive elsewhere.
Yep.
So that's my kind of 2 cents on that whole space.
I agree. And I think there's two things that people forgot largely in that discussion last year. Not everyone, but I think it didn't rise to the level of consciousness like it should have in a lot of the conversations. One is there's a lot of people that can't work from home. If you're building a car, you don't get to do that in your living room. You got to be in the stinking shop. And two is Facebook and Amazon and Google and all these places, they didn't start virtual. You know, you have people grinding it out around the clock in person, collaborating with this creative spark, and you weren't doing that at your home, calling people through Zoom and building these companies.
And I think you've got to be careful what you wish for, because if you really want to do a work from home deal, you're going to get paid a lot less. You're going to miss out on climbing that ladder corporately because you're just not around, and you're going to have to give up a lot of your privacy rights because your employer is going to want to check in on you and make sure that you're doing what you say you're going to be doing all the time.
Yeah.
And that's a deal that you probably don't want to make.
Yeah.
You need some delineation between your private and professional life. I mean, we've all blown apart our privacy concepts over the last 20 years, which that's a different conversation, but I think this is a bridge too far.
Yeah.
And as an employee, I don't think you want to make the deal with the devil like that.
Yeah, that's interesting. I hadn't thought of that. But yeah, I mean, call me old-fashioned, but I like driving to an office and doing work and driving home. And I understand when you drive home, you do work at home in the evenings or Saturdays or whatever. But I think it's hard to beat having a place that you go to with the team you can collaborate with, and you do your thing and you go home. But also I understand a lot more people are going to work remotely going forward. That's fine. I mean, there are certain positions, like you said, coders or straight commission salesperson who's on the phone every day. That doesn't matter if they're going into the office to call people around the world or they're doing that at a remotely location. So there's some things that work better that way. I just didn't see all the buzz that I was hearing last year about all going remote and everything and staying remote and what are we going to do with these office buildings and they're never coming back. I just never really truly bought into that.
Yeah, and actually this morning I was looking at some articles and some reporting year over year. So, obviously pre-COVID versus in a post-COVID space, sales volume of office investment properties is higher now than it was pre-COVID in London and New York.
Wow. That surprises me. And it also surprises me that these tech companies are buying office space. I just wasn't aware of that.
Yeah. I mean, I don't know how much they publicized it, but
yeah.
They clearly think that it's going to have a need. And the Microsoft CEO, I can't remember his name off the top of my head, but he's been very vocal about getting people back into the office.
Oh, yeah?
So that's a leading indicator to me because tech is the largest employer in America now.
Yeah. Yep.
And that drives the whole economy.
Yep. Last question. It seems to me that you would have some experience both with what you do with these projects, but also seeing the people you're around and so forth, just the facing challenge and adversity and even failure. How do you think about challenge, adversity, and failure? If you have a project you're working on, all of a sudden this changes, and you need to adjust things or create a plan B because plan A is just not going to work anymore, or dealing with a project that just isn't going to work. Like how do you, or even with seeing the people that you've seen, you mentioned kind of working through that messy middle. I'm just kind of curious with both your experience and the people that you are around, how do you think about challenge, adversity, and even failure?
I think the hero culture within financial services is problematic. And I really would encourage people to be more open to being vulnerable and not talking about how great they are and discussing more about the mistakes they've made. Mm-hmm. Because it's much more helpful to other people to not step in that same pothole twice than it is to hear about some white 40-year-old guy talk about how awesome he is at doing deals. Mm-hmm. So I went through a very difficult stage in that messy middle of my career where, I'd grown too fast. I didn't have the ability to scale. I did not put the time or the energy into building the infrastructure to allow us to scale. And it was a really challenging period. But it's made me a much better manager today. Mm-hmm. It's fundamentally shifted the way I think about the business. So I think everyone should read some more Brené Brown and get comfortable with talking about your failure, being open to that criticism and being vulnerable, because it will help you grow quicker.
Mm-hmm. Yeah, I totally agree with that. Yeah, and I do think that with being able to sort of filter your message with now, like all the social media and everything, you can sort of filter out the stuff you don't want and lead with the stuff you do, and it can entirely change someone's perception of you and your story and journey and all of that. So,
Yeah. I mean, the evil of social media can wait for another day, but
Yeah.
I promise you, whatever artifice you're throwing up there or costume that you put on in the morning, it's not the reality for most people.
Yeah. 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 I totally agree. Anything else you want to leave with our listeners before we wrap this up?
I apologize to Poyle for wanting to fire him, but it is what it is, man. Like, it's dumpster fire time.
I think you can handle it.
Trade everyone, fire everybody.
Go Preds.
And now they're going to go on a win streak. I look like a total schmuck. It's okay.
I'd be happy with that. That'd be good. That'd be good with me. Brian Adams, thanks so much for being on the podcast.
Yeah, man, that was a ton of fun. Thank you for hosting me. Yeah,
Absolutely. Thank you again.